Warren Buffett made a bet with hedge fund managers in 2007. $1 million on the line. His prediction? A simple index fund would beat a collection of hedge funds over 10 years. Spoiler, he won. Easily. And the lesson will change how you invest forever. Welcome back to Solid Right, where we break down the new rules for building wealth. If you're new here, hit that subscribe button, because every week we expose the financial traps keeping you broke. All links in the description, plus the free wealth building guide at bluewave-marketing.com. Here's what happened. A hedge fund manager named Ted Seides picked 5 hedge funds. These were the best of the best, multi-billion-dollar funds, teams of PhDs, proprietary trading algorithms, fancy offices in Manhattan, 2 and 20 fee structure. That's 2% of assets plus 20% of profits. These guys wore expensive suits and talked about alpha generation and risk-adjusted returns. Warren Buffett picked the Vanguard S&P 500 Index Fund. 0.04% expense ratio. No fancy algorithm. Just owns all 500 companies in the S&P. Boring. Passive. Automatic. 10 years later, the index fund returned 125.8%. The hedge funds? Average, 36.3%. The index fund tripled their performance. These weren't bad investors. These were literally the smartest people in finance, and they got destroyed by a fund that requires zero skill to manage. Why? 2 reasons. Reason 1, fees. The hedge funds charge 2% annually plus 20% of profits. The index fund, 0.04%. Over 10 years, those fees ate 40 to 50% of returns. Reason 2, nobody can predict the market. Not Warren Buffett, not hedge fund managers, not your financial advisor, not you, not me, nobody. The market is a chaotic system with billions of variables. Thinking you can outsmart it is like thinking you can predict exactly where a tornado will go. Here's what Buffett said after he won. Both individuals and institutions will constantly be urged to be active by those who profit from giving advice or affecting transactions. The resulting frictional costs can be huge. Translation: people make money by convincing you that investing is complicated and you need their help. It's not. You don't. Here's the actual strategy that beats 90% of investors. Step 1. Buy a total stock market index fund. VTI, VTSAX, FZROX. Doesn't matter which one. They're all basically the same. Step 2. Set up automatic monthly investments. Same day every month. Same amount. Doesn't matter if the market is up or down. Step 3. Never look at it. Seriously, check it once a year max. Step 4. Wait 30 years. That's it. That's the whole strategy. But financial advisors hate this advice because if you follow it, you don't need them. Hedge funds hate it because their entire business model is convincing you they can beat the market. And the financial media hates it because buy index funds and do nothing doesn't generate clicks. They need you watching every day, panicking about every headline, trading constantly, because every trade generates fees, and fees make them rich. Here's the proof. The Dalbar study tracks actual investor returns versus market returns. From 2000 to 2020, the S&P 500 returned 10.2% annually. The average investor? 4.1%. Same market, 6% difference. Why? Because people panic. They sell when the market drops. They buy when it's high. They chase hot stocks. They listen to Jim Cramer. They do everything except the one thing that works: buy and hold index funds. Let me show you what happens when you panic. March 2008, market crashes, down 50%. Millions of people sold everything. I'll wait for it to recover, then get back in. The market recovered by 2010, but those people, they missed the entire recovery. They sold low, bought high, and lost a decade of gains. Meanwhile, the people who did nothing, who kept auto-investing through the crash, they made a fortune because they bought stocks on sale during the crash. This is called dollar cost averaging. When prices are low, your automatic investment buys more shares. When prices are high, it buys fewer shares. Over time, you average out the volatility. Same thing happened in 2020. COVID crash. Market down 35% in March. People panic sold. Again. Market recovered by August. Finished the year up 18%. The people who panic sold missed it. Again. Buffett has a famous quote, "The stock market is a device for transferring money from the impatient to the patient." He's right. Every time you panic sell, you're transferring your wealth to someone who's willing to wait. So here's your homework. Stop trying to beat the market. Stop picking stocks. Stop listening to stock tips. Open a Vanguard or Fidelity account. Buy a total stock market index fund. Set up automatic monthly investments. Then delete the app and forget about it for 30 years. You'll beat 90% of hedge funds, 90% of financial advisors, and 90% of active investors. Warren Buffett proved it. Drop a comment. Do you invest in index funds or do you pick stocks? Subscribe for more investing strategies that actually work. If you want the detailed checklist with exact links, account recommendations, and the full weekend setup, check out Wealth on Autopilot. Download the free guide at bluewave-marketing.com.